Now, the Sustainable Capital Africa Alpha Fund has already generated 18% outperformance. That's since its launch in February this year. Now, the fund has found winners like the steel company in Morocco, a bank in Kenya, and a utility in Nigeria. Joining us from Cape Town to discuss the portfolio, Greg Barker, Director of Investment Research at Sustainable Capital. Greg, good to have you with us. So speaking to Mark Khalil now, he's the ultimate Afro-optimist, obviously looking from within and being able to look at opportunities on the continent. What's the perception like from outside of the continent? Are people as excited about the opportunities for investing here?
I think it varies dramatically depending on the level of sophistication of the investor. We've actually just been in Europe for a week raising capital for Sustainable Capital's funds, which are all Africa ex South Africa. And you get quite a wide range of responses from the more progressive, let's call them lead steer investors who can see the opportunity, don't need to be convinced of the investment case for Africa, and they're really just interested that we're doing the due diligence and our research at the company level with adequate care. And then on the other side, you've got investors who haven't really gone a long way towards investing in Africa-listed equities, and they tend to be the more conservative investors who, ultimately might only come in after the markets have been up by 50%. So it really varies between different countries, whether you're talking in regions, Europe, US, Asia, South Africa, and within those regions, you've got different levels of progression on the investors.
Mm-hmm. Greg, just to come in here, you obviously launched your first fund, as we understand it, was the Africa Sustainability Fund, and I think for the benefit of viewers, you obviously called Sustainable Capital. Could you just tell us what the underlying philosophy in your investment approach is and how you distinguish yourself from other investors like self-described value investors or growth investors?
Yeah, basically our philosophy is that material, environmental, social and governance factors, in addition to the normal financial analysis and rigorous investment valuation, have a direct impact on the financial performance and ultimately the shareholder value of companies. So for example, if you're looking at a real estate company with the contaminated groundwater issue, which is, say, 30% of its market value, we'd be accounting for that in our fair value in our investment decision-making process, whereas mainstream asset managers maybe wouldn't look at those factors as much. The same could be said of, for example, corporate governance in terms of conflicts of interest or social factors like labor practices. We take quite a special interest in the long-term impacts of those factors on the financial performance of the company and how that will affect shareholder returns.
Greg, so just to get this right, we've seen these annual reports locally just increase in size from perhaps 100 pages up to tomes that are as large as 300 pages, and within those there's obviously this integrated reporting which talks to some of these issues. You're very much focused on the African continent. How does the level of reporting and disclosure in the continent compare with the companies listed domestically here on the JSE?
I think on the one hand, you've got companies that are way ahead of international best practice, absolutely cutting edge in terms of sustainability and what they're doing in terms of reporting. And on the other hand, you've got companies that are quite slow off the mark and haven't really grasped the importance of that to their business case. But the key difference between, say, South Africa and Africa is that in the rest of Africa there's a very wide divergence between what's reported and the reality on the ground. So you really have to get your hands dirty. You have to be kicking the tires. You can't be researching African equities from a stuffed chair in an air-conditioned office. You've got to be on the ground in the countries, doing one-on-one management interviews, actually checking the quality of the assets firsthand and doing detailed due diligence to make sure that what's reported is actually accurate, because you get very good companies which are reporting much less, and then you get companies which maybe overstate their performance in some of their reporting, and the reality in practice is very different to that.
Greg, let's look at the funds that you have right now, because you've got the Africa Sustainability Fund launched back in 2009, and then you've got the new Africa Alpha Fund launched this year, 2012, and of course also the Nigerian Fund, which is very country specific, obviously. Firstly, what's the difference between the Sustainability Fund and the Africa Alpha Fund? I mean, why did you make the decision to launch this specific new fund? What are the key, how do you distinguish the two?
The Africa Sustainability Fund is extremely efficient. I mean, it's mainly large cap blue chip companies with strong financial track records. It's a 40 stock diversified portfolio, and the weighted average market cap of the companies in that fund, to give you an example, is $5.9 billion US. So you're talking about high capacity, efficient access at a much lower level of risk than you would get, say, in a market cap index of Africa. Whereas the Alpha Fund is a purely valuation driven, more concentrated portfolio of 15 to 25 stocks, where we have the ability to take material overweight positions in companies where the share price is deviated materially below what we believe to be the fair value of the company.
Greg, give us some examples.
So the average
of those.
size of the company would be weighted average market cap closer to $3 billion for that Africa Alpha Fund. And then the Nigeria Fund is a pure carve out of our rules-based process in the Africa Sustainability Fund, which is purely just focused on Nigeria.
Yeah, and as I was saying, you're talking about companies that you can take a material overweight position in. Give us an idea of some of the stocks that are just trading way below a level that is really deemed correct for that company.
I mean, our portfolio is actually in the process of quite a bit of change over the past couple of months, because if you look at how much differential move there's been, for example, a market like Egypt is up 64% year to date in US dollar total returns, and we were over 40% of portfolio there earlier in the year. Now, of course, some of those stocks have run over 100%, so we would have taken profits there. If you look at a country like Morocco, on the other hand, on average, that's down 17%, but some of those stocks are down, say, over 50% year to date. So just between those two North African countries, you've got an 81% swing factor year to date. Mm-hmm. Then you're seeing very good opportunities still in places like Kenya, Nigeria. So on a stock-specific basis, it's quite a dynamic process, particularly in the Alpha Fund, where once the share price has moved closer to the fair value of the company, we'd be exiting there and entering new counters where the discount is wider.
Greg, it sounds like the portfolio changes quite quickly. Is that something that you planned at the outset, that the portfolio would turn over quite quickly, or is it just this sort of series of factors that you're seeing at the moment?
There's a part that you control, which is your assessment of the company. I mean, for example, the Africa Sustainability Fund has got exceptionally low turnover. The rolling 12-month portfolio turnover is 17%, which means, it implies an average holding period of over 5 years. So you've got high conviction benchmark agnostic positions. The Alpha Fund, it really also depends on market volatility, So we'll have, let's say, a stock where we believe the fair value is, say, $100 US a share, and it's currently trading at $50 US per share. Our fair value would stay fairly stable, but if that stock happens to run up by 100% over a short space of time, like less than a year, obviously we'll take profits from that. So there's a component of the portfolio turnover which you control, and there's a component which is effectively out of your control, but provided you've got a strong buy-sell discipline, that market volatility actually works in your favor, because the more short-term pessimism you get, particularly with retail-driven markets, that drives share prices down a lot and gives you opportunities to buy high-quality companies at major discounts. And the more irrational exuberance you get, on the other hand, when share prices are driven way above their fundamentals, that's where you get to take profits at very good levels. So, and that's a key differentiating factor of Africa ex-South Africa listed equities, is because of the imperfect information, share prices just get driven a lot further than you might be used to in other markets from their fundamentals.
And of course, that kind of leads on to the whole point around stock picking and why it's so applicable to Africa. The uncorrelated nature, for example, of your sustainability fund, less than 15% over the past 3 years, whereas the JSE is 80 to 90%. So you can take a position on individual stocks trading at a discount, and then that's where you achieve your outperformance, I assume.
It's probably Africa ex South Africa is probably the last uncorrelated listed equity market in the world. So obviously, from a global portfolio manager's context, they know that South Africa is basically going to move in lockstep with European and US markets with an 80 to 90% correlation. Whereas if you look, for example, at the Africa Sustainability Fund, you're talking less than 15% correlation. So those markets are marching to the beat of their own drum. What's also interesting is even within the African countries, you're also talking exceptionally low correlations to one another. Mm-hmm. And even if you take Africa as a whole relative to frontier markets or the emerging markets basket, which is often where foreign investors would categorize Africa within frontier and emerging markets, even there you've got correlations of less than 25%. So although Africa is often considered risky because of perceptions about things like political stability, rule of law, infrastructure quality, it's actually from a technical portfolio construction process very favorable due to these low correlations.